When the Titanic sank on the 15th of April 1912, the headlines were filled with shock and grief. More than 1,500 lives were lost. The unsinkable ship had gone down on its very first voyage. It felt like pure tragedy, and it was. But at the same time, something else was unfolding quietly in the background. Money was moving. Shares were rising and falling. Companies were calculating exposure. Insurers were assessing liabilities. Competitors were watching public sentiment shift in real time. We almost never ask the uncomfortable question, who benefited? Because history tends to focus on the human drama, not the balance sheets. To understand that side of the story, we have to step into the financial world of the early 20th century. The Titanic was operated by the White Star Line, but White Star wasn't just a proud British shipping company. It was part of a much larger structure, the International Mercantile Marine Company, IMM, a massive shipping trust backed by J.P. Morgan. Morgan had spent years trying to consolidate transatlantic shipping under his control. His vision was scale, coordination, dominance of the North Atlantic routes. White Star was one of the crown jewels in that strategy. Titanic was its flagship symbol. So when the ship went down, it wasn't only a human catastrophe. It was a corporate shock. IMM's shares fell. Lawsuits piled up. Insurance claims surged. Investors panicked. The headlines were brutal. But here's the part people rarely mention. IMM was already in trouble before Titanic ever sailed. The company was heavily indebted. The consolidation strategy had stretched finances thin. Competition with Cunard was intense. The trust wasn't as stable as it looked from the outside. The disaster, ironically, created room for restructuring. It provided political cover. Public sympathy softened pressure. Negotiations could be reframed. In a strange way, the catastrophe gave Morgan space to reorganize parts of his empire. It didn't make the loss disappear, but it changed the strategic landscape. Then there were the insurers. The Titanic was insured for about $1 million at the time, roughly the equivalent of over $100 million today. Lloyd's of London and numerous smaller underwriters paid out. Some smaller insurers were hit hard. A few went bankrupt. But the larger institutions absorbed the shock and emerged stronger. Weaker competitors disappeared. Market share consolidated. In finance, sometimes paying a large claim is still preferable to losing structural dominance. The media industry saw something else entirely. Newspapers printed extra editions. Circulation spiked. The New York Times gained prestige and subscribers with detailed reporting. Across Europe and America, demand for coverage exploded. It was the biggest media event of its time. Publishers profited directly from public grief and fascination. Within months, survivor memoirs were on sale. Lectures toured cities. Exhibitions displayed recovered artifacts. Even vaudeville theaters dramatized the sinking. Tragedy became content. And content became revenue. Years later, the story would continue generating money, books, documentaries, films. One of the earliest silent films, saved from the Titanic, was released just 29 days after the disaster and starred an actual survivor, Dorothy Gibson. Decades later, the cultural brand reached its commercial peak with the 1997 film directed by James Cameron, earning over $2 billion at the box office. A single shipwreck evolved into a century-long revenue stream. Meanwhile, Cunard, White Star's competitor, benefited directly in the years after the sinking. Public perception shifted. Cunard ships, like Lusitania and Mauretania, were seen as safer and better managed. Passengers chose accordingly. Market share moved. In business, one company's disaster often becomes another's advantage. Shipbuilders like Harland and Wolff initially faced scrutiny over design and safety, but demand for safer ships surged. New regulations required more lifeboats and stronger safety measures. Retrofitting contracts followed. What began as scandal became demand. Demand became contracts. Contracts became revenue. And this reveals the larger pattern. Disasters rarely erase capital. They redistribute it. Some lose everything. Others consolidate. Rivals gain customers. Insurers restructure. Manufacturers pivot. Media scales. Behind every headline about tragedy, there's always a balance sheet somewhere adjusting numbers. We use the term disaster capitalism today. But the mechanism was already visible in 1912. Fear creates urgency. Urgency creates regulation. Regulation creates contracts. Contracts create profit. This pattern didn't end with the Titanic. When Hurricane Katrina struck in 2005, rebuilding contracts flowed to construction firms and private contractors. During the 2008 financial crisis, hedge funds bought distressed assets at fractions of their former value. During the COVID-19 pandemic, entire sectors collapsed while technology, logistics, and pharmaceutical companies expanded dramatically. Every crisis redistributes capital. The Titanic is not just maritime history. It's a case study in how financial systems absorb shock and reorganize around it. White Star lost a ship. Families lost loved ones. Investors lost money. But capital didn't disappear. It shifted. That's the uncomfortable truth. Our financial system doesn't pause for grief. It recalculates. It adapts. It looks for advantage in instability. This isn't about celebrating that reality. It's about understanding it. Financial awareness isn't just knowing how to save or invest. It's recognizing structural patterns. When crisis hits, ask, where is money flowing? Who is gaining contracts? Who is acquiring assets cheaply? Who is increasing market share? Because if you're not aware of those movements, you're only seeing half the story. History doesn't repeat an exact form, but it rhymes. And again, the rhyme is the same. Tragedy shocks the public, and capital reorganizes quietly behind the scenes. The Titanic was a human disaster. It was also an economic event. Both truths can exist at the same time. Understanding the dual reality is not cynical. It's necessary.